Welcome everyone to Kickstarting Spring with a compliance refresher on HSAs. Thank you so much for joining us. Yoko will be answering the questions you send through the Q&A today. We will try our best to answer all of your questions, but if for whatever reason we are unable to get to your question today, please follow up with your advisor for further assistance. Today's presentation is being recorded. We will be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At this time, I'd like to introduce our speakers for today's call. Joining us today are Roger Abramson, Vice President and Counsel of Benefits Compliance at NFP, and Carol Wood, Vice President and Counsel of Benefits Compliance at NFP. Carol, the floor is yours.
Thank you so much, Amber, and good afternoon, everybody. It's a pleasure to have you with us today. As Amber stated, our topic is Kickstarting Spring with a compliance refresher on HSAs. We know that spring officially began yesterday evening, so it's very timely. Here are our smiling faces. Again, I'm Carol Wood, joined by my colleague, Roger Abramson. And before we begin the presentation, we just want to remind you that the following is intended to be used for general informational purposes only. It's not intended to be tax or legal advice. Any question regarding a specific application of the law should always be addressed to legal counsel. The information is current as of today, March 20th, 2024. And to review our agenda here, I'll start out with an overview, fairly brief, of health savings accounts. Then we'll discuss eligibility. That will be a little more in depth. This is an area where we see a lot of inadvertent compliance issues. Then Roger will discuss contributions, quite timely with that IRS tax filing deadline coming. He'll also discuss distributions, qualified and otherwise. We'll briefly touch on tax reporting. Don't worry, it's just one slide. And then we'll have some compliance takeaways. And throughout the presentation, there are FAQs and some compliance nuances for purposes of reinforcement. And we'll start out with the HSA overview. HSAs are not group health plans. Of course, they're coupled with a high deductible health plan. Rather, they're individually owned accounts and they're portable. Employees can take them with them if they go to another job. The HSAs have triple federal tax advantages, and they're also considered to be a component of consumer-directed health care. The idea here is that an employee has skin in the game, they're aware of the costs, and they're encouraged to comparison shop to obtain the best cost because they'll be covering those expenses before they meet their deductible or out-of-pocket maximum. The HSA HGHP arrangement also helps the employer control expenses. Typically, those HGHP premiums are less than other types of traditional coverage. Let's start out looking at this, each of those elements a bit more closely. We said the HSA program generally is not a group health plan. It has to be paired with a qualified HGHP. So by not being a group health plan, this means that the HSA program is typically not subject to ERISA, HIPAA, COBRA, the ACA, and other laws. So that's the good news, right? If there's no ERISA plan document, Form 5500 filing required, and no fiduciary obligations for the employer. However, in order to make sure that ERISA does not apply, the employer must limit their involvement. And we have some guidance here, specifically the employee establishment of HSAs must be completely voluntary. So this means employee contributions, whether through a cafeteria plan or otherwise, must be completely voluntary on their part. It doesn't mean, there is some guidance on this as well, it doesn't mean that an employer can't establish HSAs for employees. I think you just have to be careful in doing that, first to make sure employers are eligible, but also to make sure that it's communicated to them what's happening with that process, because if you establish an HSA for an employee, if it's opened, it can be closed again, sometimes if they don't provide sufficient information to the bank for the bank to complete its verification process. And we'll be stressing throughout the presentation how important it is, those communications to employees. Employers also must not limit the ability of employees to transfer their funds to another HSA. Once they're deposited in that, with that custodian, the employee is free to do what they want with those funds, impose any conditions on the use of the HSA funds. We hope they use them for qualified medical expenses, but that may not be the case. The employer cannot make or influence HSA investment decisions. Now, an employer can offer an investment lineup. Typically, it's through an arrangement with their custodian, and they can mirror the 401k if they wish to do that. But it's free to the employee to decide whether they want to invest their funds or not. Employers should not represent that the HSAs are a group health plan. You have to be careful here with your enrollment materials. And also, if you purchase from a vendor as a part of a bundle, HSAs with a health FSA, be sure that health FSA where a BAA applies, you're not incorporating the HSA in that as well. The employer should not receive any payment or compensation in connection with the HSA. And remember, the high deductible health plan, of course, is a group health plan, has to comply with all the group health plan laws. And additionally, most HSA programs are offered through a cafeteria plan, which are subject to the Section 125 rules, and that includes non-discrimination rules. We said the accounts, the HSA is individually owned, and that means the terms are usually governed by a deposit agreement with the HSA custodian. And that's the main relationship. It's important to understand that HSA custodian is looking out for the individual, the employee in this case, and their main objective is to safeguard those funds, for the account owner. So the employer has to look at this very differently than their other group health plan arrangements. They're just the third party facilitating contributions. They don't have any rights to any of the account history or information of the employee. So the employee owns the account. They set the contribution level and determine investments, if any. They're free to transfer funds to another custodian, and they can maintain the HSA after employment ends. The employee also has obligations. They are ultimately responsible for determining their own eligibility, for making contributions within limits, and those limits apply on a calendar year basis, regardless of the HDHP plan year. Employees are also responsible for using funds for qualified medical expenses if they want those tax advantages, for maintaining records for expenditures, and also for tax reporting on Form 8889 that's filed with the Form 1040, and any applicable corrections. Hopefully they don't have any. But the employer, although it's ultimately employees' responsibility, the employer should work with a custodian to educate employees regarding these obligations. Okay, we said that the HSA is triple federal. You'll notice the little asterisk there. Tax advantages. First, with contributions, if they're made pre-tax through a Section 125 cafeteria plan, then the employee and employer contributions are not included in the employee's income or subject to payroll taxes. So the no payroll taxes is an advantage for both the employee and the employer. For certain individuals, they may not be eligible to make contributions through the cafeteria plan, for example, an owner. So they can make if they're otherwise eligible, a post-tax contribution and take a deduction. And we say it's an above-the-line deduction for those contributions outside of payroll. And by above the line, we mean, of course, that it's a deduction that's taken from gross income before we get to adjusted gross income. Because once we get to adjusted gross income, there are phase outs, often based on income levels, as far as other deductions that can be taken. We tend to like those above the line deductions. The other advantage is earnings growth. Any interest, dividends, and capital gains are not subject to federal taxes. And of course, there's potential as a retirement savings vehicle. Some people say, well, it's very a small percentage at this point, but after an individual has met perhaps their deductible and out-of-pocket maximum, It's a great way to save, and you can defer having to pay taxes on the capital gains and earnings. And I would point out there's some controversy here because there is some, with all these advantages, HSAs are great. There's criticism that the wealthy are mainly benefiting from these accounts and using them as retirement savings vehicles. There are also advantages with respect to distributions provided. They're for qualifying medical expenses. Those are not taxable. And just pointing out at the end that the vast majority of states offer similar tax advantages. There are a few exceptions, so you always want to verify the state tax treatment with a tax advisor. Last I knew, I believe it was California, New Jersey were two where there were exceptions. But again, these can change, so you just always want to check with your tax advisor. Okay, moving on to HSA eligibility requirements. Let's first look at the basics. To be HSA eligible, an individual must be covered by a qualified HDHP, have no other impermissible coverage, not be enrolled in Medicare, not be claimed or even eligible to be claimed as a tax dependent of another. Keep in mind, HSA eligibility is always determined as of the first day of each calendar month. And the HSA eligibility status of a spouse or other family member is not relevant. They may be covered by the same HDHP. Spouse is on Medicare, but if you're HSA eligible, you're HSA eligible. The status of your spouse would not affect you. Okay, then we said a requirement is to be covered by a qualified HDHP. First, there are minimum deductible and out-of-pocket maximums that apply, and these change each year. For 2024, for single coverage, the minimum deductible, statutory deductible must be at least $1,600. For family coverage, $3,200. The out-of-pocket maximum for single coverage, $8,050, and for family coverage, $16,100. No benefits can be paid until the minimum statutory deductible is met, with certain exceptions. We're listing some here. There are others. Among these, dental and vision expenses, preventive care, COVID-19 testing and treatment expenses. That's ending soon. That's just for plan years ending on or before December 31st of 2024. Telehealth services. This also is just temporary, and we'll be discussing that more in a moment. Certain insulin products. Benefits permitted under IRS Notice 2019-45 at an employer's option, and this is a number of items that are generally low cost, such as statins for heart disease or diabetes that an employer can cover before the deductible is met. The IRS does not allow drug coupon or assistance to apply to the cost sharing limit. Yeah, this whole drug coupon area is, quite frankly, a hot mess. State laws may impact treatment by insured plans. The IRS has always been very clear that any drug coupon or assistance that benefits an individual doesn't apply to their cost sharing limit, but some state laws say that it has to apply. And then we had a district court ruling last year that left the application of drug coupons even more questionable. So this is an area where an employer should just consult with counsel if an issue arises. We don't have clear guidance at this point. Impermissible coverage. This is a long list. It's any coverage providing non-accepted benefits before the HDHP statutory deductible is met. This includes Medicare, all parts A, B, C, or D, and it's entitlement. That means enrollment. It's not just eligibility for Medicare. Keep in mind also that Part A coverage may be retroactive up to 6 months, and that can impact your HSA eligibility. Medicaid is also impermissible, as is TRICARE. Receipt of VA medical benefits during the preceding 3 months, unless, however, it's for preventive care services or medical hospital care for a service-connected disability, or VA medical or hospital care received by a veteran with a disability rating can also be disregarded. Some other examples here, and this list is not exhausted. General purpose HRA or health FSA coverage, and that includes coverage through a spouse. Technically, an HRA or health FSA for your spouse probably could be designed to just cover the employee and not a spouse as well. I have yet to see one that doesn't cover a spouse. So, if you have coverage through a spouse, it's more likely than not that you will not be eligible to contribute to an HSA. Grace period or carryover provisions can also extend the ineligibility period, and we'll discuss that more momentarily. Post-deductible or limited purpose HRAs or FSAs are allowed. For example, those that cover only vision or dental expenses or pay only after the minimum HDHP statutory deductible is met. Other impermissible coverage can include on-site medical clinics, EAPs that provide significant medical benefits, or a point solution program. And you really have to look at the facts and circumstances here with some of these with an on-site medical clinic, and to see if it can fall into an exception or not. Be careful with hospital indemnity policies. A fixed amount payout per day for a period of hospitalization is generally permissible, and that's really what our traditional hospital indemnity is. But if the coverage has more bells and whistles, it's service-based, or provides significant other benefits, such as maybe ambulance coverage, then it may not be. So you really need to look carefully at those policies. Generally, employers should review the benefit offerings carefully for HSA compatibility. Okay, let's look a little more closely at the effect of an FSA grace period or carryover on HSA eligibility. A grace period, as we know, extends the FSA plan year by up to 2.5 months to allow employees more time to incur claims. We said HSA eligibility is always determined on the first of the month. With a grace period, generally, the participant is not HSA eligible until the first of the month after the grace period ends, unless they have a zero balance at plan year ends. So as an example, Roger's 2023 calendar year FSA has a 2.5-month grace period. So he would not be eligible to contribute to an HSA until April 1st of 2024. However, if Roger had a zero balance on December 31st of 2023, he would be HSA eligible on January 1st of 2024. Alternatively, an employer could elect to have a mandatory conversion of the FSA to a limited purpose or post-deductible FSA for all participants. With a grace period, if the employer takes that type of action, it does have to be for all participants. Let's look at a carryover. If the FSA has a carryover, this allows an index amount. It's equal to 20% of the salary deferral limit for the year, so that would be $640 for 2024, to be carried over from one plan year to the next. An FSA carryover will generally prevent HSA eligibility for the entire following plan year. So if Roger's plan had a carryover instead of a grace period, we could just have one or the other, he would not be HSA eligible until January 1st of 2025. However, the health FSA plan could be designed to allow or require a carryover balance to a limited purpose FSA for employees electing the HSA with the HDHP, or allow employees to waive or forfeit the carryover balance to allow them to contribute to an HSA. Employers that introduce an HDHP and HSA combination mid-year must recognize the interaction of existing health FSA coverage with the new offering. And importantly here, offering an HSA is not a qualifying event that allows FSA participants to drop coverage. Okay, just a little review here, make sure everybody's paying attention. Is HSA eligibility impacted if the employee's spouse is enrolled in Medicare or other impermissible coverage? No, it's only the employee's own coverage that matters. If a spouse or child has other coverage, the employee is still eligible for the HSA. Unless the employee is also covered under the spouse's impermissible coverage, as we said, for example, with a health FSA. The contribution limit is still based on the tier, whether it's single or family coverage. Okay, mid-year offering, the employer sponsors a health FSA and is adding an HDHP and HSA mid-year. What are the considerations? And this is meant to be an example, I should say, with a grace period. The employees participating in the health FSA will not be eligible for the HSA until the end of the FSA plan year or grace period if applicable. So we assume it has a grace period. The addition of the HSA and HDHP is not a qualifying event permitting individual employees to change their FSA election. The employer could choose to make changes to the entire FSA to allow employees to access the HSA. But this may not be advisable if participants were not made aware of the upcoming changes prior to enrollment. I think anytime you're thinking of a mid-year offering of an HGP and HSA, you should review with counsel, particularly if you have either an HRA or FSA. Telehealth services. Do telehealth services adversely impact HSA contribution eligibility? Generally, yes, telehealth services could negatively impact HSA eligibility if providing non-accepted medical benefits before the HDHP deductible is met. However, through various legislation, most currently the CAA of 2023, a participant can maintain HSA eligibility even if first dollar coverage of telehealth services is provided. The relief currently applies to plan years beginning after December 31st, 2022 and before January 1st of 2025. So it will end at the end of this year, December 31st, 2024, for calendar year plans, unless relief is extended again or it's made permanent. And there's certainly been talk of that, but nothing concrete has materialized just yet, but we are monitoring it. This we haven't discussed yet, and I think this is important. What are the employer's obligations to verify an employee's HSA eligibility? The employer is responsible for determining, first of all, that the employee is covered by an HDHP and has no disqualifying coverage sponsored by the employer, and also the employee's age, and that's for catch-up contribution eligibility purposes. And Roger will be talking about catch-ups momentarily. The employee has all other responsibility. So the employer should monitor their benefit offerings for HSA compatibility, and should also work with the HSA vendor to educate employees regarding eligibility requirements. Again, it's not required technically, but that education will benefit all and help to avoid excess contributions. Okay, and with that, we have folks interested and eligible. I'm going to turn the presentation over to Roger to discuss the HSA contribution rules.
Okay, thank you, Carol. So as Carol pointed out, we talked about overview HSAs and eligibility for same, being able to have an HSA, but eligibility is technically about having an HSA, establishing one, and contributing to it. That's essentially what it means to be eligible for an HSA. It does not necessarily apply to distributions. I'll explain that in the next section. But right now, it's about the HSA contribution rules. The fun, so to speak, part of HSAs in the sense of putting the money in and enjoying the tax advantages and the savings advantages thereof. So on the next slide, we're going to talk about these limits. we go. The HSA annual maximum contribution limits, they change from year to year. There are essentially two levels of coverage in the world of HSAs and HDHPs, high deductible health plans. We tend to be used to different levels, right? Employee only, employee plus spouse, employee plus family, employee plus child or children, those kind of things. For purposes of HSA contribution limits, there are only two levels of coverage. There's single, or what's called self-only coverage, and then there's everything else, which is non-self only, and that's considered generally family coverage. So those are it. So employee plus child and family coverage, employee plus spouse, those would all go in the pile of family non-self only coverage for purposes of HSAs. The maximum contribution limits you can see right there. To 2023, we had $3,850 for a single coverage, $7,750 for family non-self-only coverage. They do tend to increase year by year. They're tied to cost of living, generally speaking, and usually announced roughly in May of each year. So in a couple of months, we will get those 2025 numbers. But for 2024, we have single coverage, maximum limit of $4,150 and family coverage $8,300. Those numbers usually, but not always, tend to be just the family coverage tends to be double the single coverage. Not always, but most of the time. At any rate, these limits apply on a calendar year basis, regardless of the HDHP plan year. So if you run a fiscal year plan year, for instance, July 1st to June 30th, that's fine. But these limits apply on a calendar year basis, and they're based on month-to-month coverage, which I'll talk about momentarily. Also, similar, although the age is different, to say 401k rules, there are catch-up contributions. For HSAs, aged 55 or older, you can put in an extra additional $1,000 catch-up contribution on top of those limits. And that limit includes all contributions to the HSA. So wherever the money comes from, that goes toward the limit. So if the employer makes a contribution, which we will also talk about momentarily, then those numbers go toward the limit. If an employer, say, puts in $1,000 for single coverage for 2024, that number goes toward that limit. The employee can put in another $3,150. The deadline for contributions is tax day the following year. Yes, you can put in contributions to your HSA in a calendar year that can apply to the previous calendar year. That can be done. Generally, it's tax day is the deadline, which, of course, this year, as usual, is April 15th, 2024. Now, on a personal note, actually, this is true. 2 days ago, I received an email from HSA Custodian, with which I have an HSA. They're very excited for me. They got it says time is running out. A little longhand. They have a little animated clock spinning around, and it says take advantage of making a prior year contribution. Just what we're talking about. And it says, Roger, you still have time to make a prior year health savings account contribution, and the more money you put in your HSA before the filing deadline, the more you'll reduce your taxable income. That is all true. And they give me their limits. That we've just talked about for 2023. Again, that is all true, except that I cannot do that. The reason I can't do that is because that's an older HSA I still have. I maxed out my contribution in a newer HSA I have, and nowhere in this information does it say, hey, these limits apply across the board to any HSAs you might have. Now, that's not to criticize these folks. They're necessarily obligated, I suppose, to say that, but this is the sort of information that can go out there. I know I can't do that because I do this every day, but some folks may look at that and go, oh, goody, I can make an extra contribution over here. And they're going to find out they do and file their taxes that they actually cannot. But at any rate, I thought that was kind of interesting and very timely. On the next slide, we're going to talk about how these annual limits work. They are subject to proration. Essentially, HSA eligibility, which again, what that means is the ability to establish and make contributions to an HSA, is measured as of the first of each month. So if a person has a qualified HDHP and they're HSA eligible on, say, May 1st of a year, then they are considered eligible for the entire month of May for these purposes. So we have an example here. Larry enrolls in self-only HDHP coverage, and that begins on January 1st, 2024. And then he reaches age 65 and he decides to enroll in Medicare, and that coverage begins on July 1st, 2024, on the beginning of the 7th month of the year. Uh, he keeps his self-only HDHP coverage. He has that, and he has his Medicare coverage, and they continue through the end of 2024. When was Larry HSA eligible for these reasons? For just one half of the 2024 calendar year. But wait, some say, he had his self-only HDHP coverage. Shouldn't he be eligible for that entire year? No, because remember, HSA eligibility has two components. First, you have qualified HDHP coverage and no impermissible coverage. So the Medicare coverage is impermissible for purposes of HSA eligibility. So at any rate, he can make the maximum contribution of one half for $1,150, or of course $2,075. He's also eligible for that catch-up contribution, being 55 or older, and that would be the same thing. That is also prorated to $500, so you can contribute the amount that you see there. But wait, what if he failed to prorate that maximum and contributed the whole thing, thinking he's eligible the whole year? Well, he would need to remove the excess amount prior to the tax filing deadline for 2024. Otherwise, he will owe 6% excise tax on those excess amounts. Moving on to the next slide, we're going to talk about a little alternative rule called the full contribution, also known as the last month rule. Okay? So I've just told you all this stuff about how it's month to month and it's very strict and there's an annual contribution. It's every 12 months. And as often happens in these cases, there's an exception to that. And here's the exception. An employee can make the full contribution up to that annual limit, even if not HSA eligible for the entire year, provided that employee is HSA eligible on December 1st of the year. Essentially, that would mean they would be HSA eligible for that entire month of December, because again, the first day of the month is the determining day. And this is a big one, the employee remains HSA eligible for the entire following calendar year. This is sometimes called the term the 13-month testing period. And one of the reasons this is put into place was because a lot of employers would implement their HDHPs on their fiscal year, like on July 1st, and employees could only put in half the amount. So this is why this rule is there. So let's look at Cheryl. She enrolls her family in HDHP coverage on November 1st, 2024, and she makes the full family contribution to her HSA. She can do that. Everything's fine, so long as she remains HSA eligible for the entire year of 2025. If she does not, she will have to she'll be subject to income taxes on the excess contribution. There'll be an additional 10% penalty tax, and so on, that you can see through the math there. At any rate, but if she remains eligible for all of the next year, then she's able to keep that full contribution for the previous year, the year she originally started. Now, on the next slide, we're going to talk about employer contribution rules. So, contributions to HSAs are optional for employers. This question comes up a lot. Hey, we offer HDHP, and we have a HSA, an arrangement with the HSA vendor, custodian, do that. Are we obligated to make contributions? No, not necessarily. Now, many employers do for a lot of obvious reasons, but there's no obligation for employers to make contributions to HSA. It is optional. Again, though, these contributions do count toward the applicable maximum limit. They're generally non-forfeitable. We'll talk about that momentarily. They can, CAN, be front-loaded early in the year to benefit employees. That can happen. A lot of employers like to do that, especially when they're starting off with the program, to get money in there so people feel kind of more comfortable with the situation. Now, understand that if the employee terminates employment or that HDHP coverage mid-year, generally speaking, in most all cases, the employer cannot just recoup the funds. Okay, they're gone. There's not a vesting period with HSA funds from the employer. And only in limited situations can that happen, very limited, which we'll talk about. But that's sort of the quote unquote downside, I guess you call it. You can't just keep one finger on it to take it back if the employee leaves. If they were given those contributions pursuant to the terms of the plan, they are theirs. HSAs are individually owned and individually controlled as a general and controlling rule. So now, let's suppose we make these employer contributions. Are there rules? Yes. The main rule, general rule, is that there are very restrictive comparability rules with regard to employer contributions. You basically, I don't go in details, but essentially you got to give everybody the same thing. There are very, very few different categories where you can differentiate. There's full-time, part-time for employees, maybe coverage tier, and that's about it. I mean, if you make them straight, then there are very strict comparability rules. However, as we said before, there's these general rules, and then there's always one major exception, or at least sometimes there are, and that is that if you provide the ability, providing to make contributions to HSAs through a cafeteria plan, Section 125 plan, pre-tax plan, different names, but the same thing, then those rules don't apply. But we'll talk about rules that do in just a second. First of all, if you do that, then employees must be permitted to change their contribution amounts at least monthly. You have to allow that. They can't be stuck in the same election for the entire year as they might be without so-called life events or mid-year election change events like with FSAs and all that. They must be permitted to change. And by the way, there are no mid-year election change rules for HSAs. People can change them up and down as they wish, so long as they don't go above their annual limit. However, if you do that, then those Section 125 non-discrimination rules, which we talk about a lot and which are on the next slide that we'll go to, those will apply. Here they are. You're familiar with them. I'm not going to read them all. This is a good point to talk about. We've been asked a couple of times, are these slides available? They will be made available in a couple of days. Look at this slide. This slide is great. This slide not only applies to HSAs and contributions to cafeteria plans, they apply to cafeteria plans generally, of course. And here's this general information. So what sometimes happens is sometimes employers hear, hey, if I have this cafeteria plan, then I can do anything I want with contributions. No, not exactly. I mean, can I give it to just these people up here? Probably not. These rules apply. They're much more flexible, but there are still some rules that apply. There are much better but more flexible rules than the comparability rules. This is why most employers offer these through their cafeteria plans. Next slide. So FAQ, we got mid-year coverage changes. How are contributions impacted if a employee's tier of coverage changes mid-year? This happens occasionally. So remember that full contribution rule or last month rule we talked about? Well, that same rule applies, essentially. The full amount based on the tier of coverage on December 1st, they can contribute the greater of that or the total of monthly contributions based on the coverage tier. So we have this example. Leon has single coverage, self-only coverage, effective January 1st, 2024. He gets married in the middle of the year, adds his spouse to his HDHP on August 15th, 2024. That's great. This means Leon had single coverage for 8 months. Why 8 months? Because you're like, look, it's August. Well, because remember, August 1st would be his determining date for August. So it would be September, October, November, December. And he had family coverage, those 4 months I just mentioned, for a total contribution of that. So at the end of the year, he could put in the $5,533, or, hey, full contribution. He can put in the whole thing. But again, remember that testing period for the next year does apply in terms of HSA eligibility. Next slide, we're going to have another FAQ. And that's going to be the excess contribution correction. Okay, so what should be done if an individual contributes to their HSA, or in my case, or others who have multiple HSAs because they haven't combined them for whatever reason, in excess of the maximum limit? The individual will need to take corrective action. Now, the rules are very favorable if you do things in time. Excess contributions must be included in gross income and may be subject to a 6% excise tax if they are not timely removed. Generally, to avoid this tax, the removal must be done by April 15th. Boy, that date comes up a lot, doesn't it? After the end of the tax year of the error. Okay? Because this is an income tax issue, HSAs are very income tax oriented. Obviously, individual tax situations are very specified and different. So it's always advisable to consult with a tax professional, but there are procedures in place to correct excess contributions so long as they're done in a timely fashion. On the next slide, we have another FAQ that we get a lot. And this is, can an employer recoup a mistaken HSA contribution? This comes up a lot. Remember, we talked about employers who, for instance, have a deal where we put in some money at the beginning of the year and then they quit next month, and we want our money back. Uh, generally speaking, the answer is no. These are not like FSAs or HRAs where it's sort of accounting deal. We got money over here that we can hold and send back. This is a bank account. Okay, this is like putting money in a 401k that's not subject to vesting rules. It's gone. As long as it was provided in terms of the plan, it's theirs to do with what they want to, subject to tax rules. The account holders, I mean. So, generally speaking, they're non-forfeitable. There are very limited exceptions available. For instance, we find out the individual is never HSA eligible, excess contributions, possibly clear and convincing evidence of an administrative or process error. Perhaps it was supposed to go to John Smith, but it actually went to Jane Smith's HSA. Those are possibilities, but any such recoupment must be made at the end of the tax year, not the filing deadline. For instance, it would be the end of 2024, December 31st for 2024. Now, having said all of that, there may be some roadblocks in place. HSA custodians, HSAs are essentially bank accounts or savings accounts. They're subject to many of the same rules, generally speaking, as bank accounts would be. And they don't tend to be real excited about just handing out money to anyone other than the account holders, except in very limited circumstances. And those tend to be addressed uh, with the agreements that an employer might have, if any, with the HSA custodian or vendor. But it is possible, but there's a lot of hoops to jump through. Generally speaking, once the money's in the account, it is gone, absent these limited exceptions. Now, we talked about how the money goes in. Let's talk about how the money comes out. HSA distributions. On the next slide, we're going to talk about these timing issues. Distributions. I'm going to repeat this. This is one of the main things to learn about HSAs. This will help in a lot of ways if you still find them a little confusing. I'm going to repeat it again. HSA eligibility only has to do with establishing an HSA. Hey, I'm eligible. I'm going to start one, and making contributions to that HSA. As odd as it sounds and as counterintuitive as it sounds, it has nothing to do with distributions. The question comes up a lot. We'll talk about this in a second. Somebody's HDHP eligible, 2024, 2025, 2026, they go on a plan that's a low deductible plan. It's impermissible coverage. They're not eligible HSA anymore. They can't make any contributions, but could they make distributions to cover qualified expenses, even though they are no longer HDHP covered? Absolutely. So we're going to talk about those rules. So these things are designed to reimburse participants for expenses incurred for Medicare for the HSA owner and the owner's spouse and tax dependents, as defined in Code 213. Tax dependent generally refers to children under age 19 or under age 24 and a full-time student, as we tend to think about the old definition of tax dependent still exists in a lot of ways. And you might be thinking, wait a minute, I thought we had to cover people till age 26. So the age 26 rule that was part of the ACA healthcare reform a number of years back, those do not apply here in terms of whose expenses can be covered by an HSA. Now, they may qualify under tax dependent rules. They may be a qualifying child or qualifying individual, but those are very specific rules that do not incorporate the age 26 rule. IRS publication 502. If you feel like, boy, I would like some exciting reading, you can go look that up, and you get look at IRS publication 502. It talks about these qualified medical expenses. They do include pre-deductible medical and drug expenses, co-payments, dental vision costs. I think we had a question in the Q&A about over-the-counter without prescription. Yes, we can do that again. Starting, it was retroactive January 1st, 2020. And so you can do that. And some insurance premiums and coverage are eligible. I think we had that question as well in our Q&A in some cases. So COBRA or USERA continuation coverage, uh, maintenance of a health plan while receiving unemployment, and yes, health insurance other than Medicare Sup if you're 65 or over. But those are very rare or very limited exceptions. Generally speaking, other than those, you cannot use HSA money for insurance premiums. In addition to that, subject to some limits, you can use HSA money for some long-term care insurance premiums. The next slide, we're going to talk about distribution timing issues. Establishment rule. To pay for an expense, a qualified medical expense must be incurred after the HSA is established. You have to establish it. If you establish it just January 1st, 2024, and you think to yourself, ooh, I remember I had 10 years ago, I had a very expensive surgery. I would love to reimburse myself. Well, unless you had an HSA then to put it over, you cannot do that. It has to be incurred after the HSA is established. Establishment is based on state trust law, which typically requires a trustee funded money is in there. So basically, HSA may not be established until funds are deposited, generally speaking. Now, there is an exception that applies if an individual had a prior HSA. If it was a prior HSA, as I mentioned, I did, many people do, had a positive balance at any time during the 18-month period preceding the new HSA's establishment, then the new HSA you have, the subsequent one is deemed established back when the prior HSA was established. So we can kind of piggyback for timing purposes on that prior HSA, so long as that there was a positive balance within an 18-month period. In the next slide, we're going to talk about a couple more timing issues. This is a fascinating rule about HSAs. That is just very, very favorable for HSA account holders. It's called the shoebox rule. I don't know who puts their receipts in shoebox anymore. I think my mother does, possibly, but that's about it anymore. But back in the day, HSAs are 20 years old this year, by the way. We still put stuff in our shoeboxes, and we liked it. And the rule is called that because you can take HSA distributions for medical expense at any future time. So if you go out today and you have an out-of-pocket expense qualify for $250, do I have to, reimburse myself this year? You do not. As long as you keep your records that it was a qualified medical expense, not previously reimbursed by any other source, and was not taken as an itemized deduction any prior taxable year, then yes, you can take it out to reimburse yourself in 2035 if you'd like. These are essentially savings accounts. They're sometimes called health IRAs for health, and that's not too far off the mark. And in fact, as we talked about, you can, CAN, take a distribution of medical expenses incurred even after the HSA account holder is no longer eligible for further contributions. Next slide. We're going to talk about the tax treatment, be very quick about that. HSAs are one of the most tax favored accounts and things in the tax code. The money goes in, you can deduct that or above the line. If you pay, it grows tax free. You're not taxed on the growth. And if it's for qualified medical expenses, you see right there, it's free and clear, no taxation. Now, distributions for non qualified medical expenses after an account holder has reached 65, you can do that. Those would be taxable, or disabilities occasionally in there as well, but those are taxable as income. Any other distribution is taxable in income and subject to a 20% excise tax. Now, some people see taxable and penalized, and they think, well, wait a minute, isn't taxing the penalty? No, the tax just means if it's taxable, it's thrown into your gross income. Taxable and penalized means it's thrown in your gross income and subject to a 20% excise tax. But as long as you have it's a qualified medical expense, free and clear, even if it's 20 years down the road, so long as you keep your records. Couple special situations, rollovers and transfers, and so forth. Generally non-taxable. That makes perfect sense. If you have a couple of HSAs or something, have a new one, you can just roll over tax-free, even though that's technically a distribution. But that makes sense. Interesting couple of rules here with the death of the account holder. If you have a beneficiary as a surviving spouse, then it remains an HSA. It's just in your spouse's name, non-taxable. If the beneficiary you have for your HSA is anyone else, then these HSAs essentially liquidated. It's no longer an HSA, and that's taxable to the beneficiary, subject to the usual tax laws in that regard. And next and final slide for me, we have a little bit of a FAQ, I believe. Yeah, taxation of non-qualified expenses. I'm not going to bore you with these numbers, but what happens if the employee uses HSA funds to pay for a non-qualified expense? Well, as we talked about, it's included in the gross income and subject to an additional 20% penalty tax. Now, you can return that mistaken distribution to the HSA no later than April 15th, following the year in which the mistake was known. That's available as well. Again, we have corrections for excess contributions and also for mistaken distributions. It's reported on Form 8889. That is the health savings account reporting form. That's put in with your Form 1040 if you use one of those online tax helpers, a little software. Then they will ask you, and you will answer yes if you have one, and it goes from there. Now, I will say that 20% penalty tax does not apply to non-qualified distributions following the account holder's death or after account holder's age 25 or 65 or after the account holder becomes disabled. That's the same thing we just talked about um, previously with regard to those expenses. And with that, I'm going to turn it back over to Carol.
Thank you so much, Roger, for that great overview of contributions and distributions. Quite a lot of material there. We're just going to discuss very high level here HSA tax reporting, just so we have a basic familiarity. The employer reporting obligations. Employer has to report HSA contributions made through a cafeteria plan. That's in box 12 of Form W2, and that's done with a code W. Most of the obligations for reporting are on the HSA custodian. The HSA custodian reports all contributions to the account for the year on a Form 5498 SA. That's filed with the IRS and sent to the account holder by May 31st of the following year. And keep in mind, as Roger said, the timing of that is related to the fact that employees or individuals have until April 15th to make contributions for the prior year. The custodian also reports all distributions from the account for the year on the Form 1099 SA, and that's provided to the account holder by January 31st of the following year. Account holder reporting obligations. Individuals who had HSA contributions or distributions must report the activity on Form 8889, and that's included with their individual tax return, the Form 1040. The Form 5329 may also be required if they need to report any excess contributions on the related earnings. And we just want to leave you with some compliance takeaways. HSAs can lower health plan costs for employers and provide significant federal tax savings for both employers and employees. Employers should always plan proactively when implementing HSAs for the first time. Major introduction is generally not advisable. Coordination with the HSA custodian vendor is very important to ensure the account setup process and the employee communications are clear. Employees are ultimately responsible for compliance with eligibility, contribution, and the distribution rules, but they may need education on these requirements. Employers, however, offering HSAs through a cafeteria plan, which is most employers, must verify the employees are covered by an HDHP and do not have other impermissible coverage, such as a health FSA or HRA with the employer. And actually what the rule states is that the employer should have a reasonable belief at the time the contributions are made that the amount can be excluded from the employee's income. And I mention this because if the employer knows that the employee enrolled in Medicare or they're not HSA eligible, then they shouldn't be allowing or making contributions for that employee through the cafeteria plan. Employers should consider funding any employer contributions throughout the year rather than in a lump sum. And it's also important to have a written contribution policy. So many times we hear questions, well, the employee left mid-year or they started mid-month, and are they entitled to the contribution or not? And there really aren't rules to govern that. So a lot is going to come down to your written contribution policy, and was the employee informed of the eligibility requirements and the timing. Otherwise, they could argue, hey, I relied on the fact that I'm entitled to this contribution, and you shouldn't deny it to me in the various circumstances. Employers should be aware of the Section 125 non-discrimination rules and the advantages of mid-year testing to prevent test failures. You don't want to wait till the end of the year when it's essentially too late to make any corrections, and then there could be tax consequences for the highly compensated. And please review our comprehensive HSA employer guide and toolkit for further details. And if you'd like a copy, please contact your broker or consultant. We have a fantastic employer guide. It's really comprehensive, and it answers all of those daily questions that employers get. And we update it regularly, so please be sure to ask for a copy if you don't have one, and refer to it if you do have one. With that, I thank everybody for joining us today. We know your time is valuable. And looks like we have a few minutes. Yoko, do we have any questions that may be worth discussing?
Sorry, I was muted. Yeah, thank you so much for Karen Roger. We have quite a few questions today, and some of the outstanding question is one of them is the employer responsible for the compliance of the last month rule?
That's an interesting question. The employer is making a contribution at the end of the year, and I can see the concern that, how does the employer really know if they're going to be uh, eligible for the entire following year? So I can see that's a challenge, and I'm not aware of guidance on that. But I think ultimately, it's going to be it's going to be the employee's responsibility. And I think that just needs to be made clear to the employee, because if they fail to remain eligible for the testing period, they're the ones who are going to have to make the corrections and suffer the tax consequences ultimately.
That's very helpful. Thank you.
I don't know if Roger has any other thoughts on that. Roger, I know you covered
Um,
the section.
no, not too many. I think it's related also as I'm looking at the questions to a question that's related to that same one, which is essentially, hey, this testing period rule. Who monitors HDHP enrollment for the year after the full amounts contributed? It's a similar question to the previous. And how would someone know? How would someone get caught? And put in quotes, which is a fair question. Well, to add on what Carol said, the employer has limited responsibility, but it also can't just put its head in the sand either. And then which is an interesting line to walk. It is These are individually owned accounts. They are monitored by the tax code and are self policed by the taxpayer, and of course subject to auditing and the follow-up things the IRS would do. So the employer has high knowledge or knows an issue, they may have to take care of a few things, but in a lot of cases, employers don't. One of the reasons a person might be ineligible, the employer might in the next year have. The employee might have the HDHP; they're perfectly fine. But it turns out the employee is covered by their spouse's FSA from that spouse's employer. This employer has no idea, would not know about that at all. And so, they're not required to go checking around. They should have those questions in their, enrollment materials and that kind of stuff just to keep things going. But ultimately, generally speaking, these are taxpayers. There's a taxpayer responsibility. An example I sometimes use, there's a lot of traffic analogies. It's like, how would someone get caught? Be like, well, there's a backcountry road that, if you go over the speed limit, you're tagged, with a significant penalty. Is there always, somebody there with a speed gun checking? Maybe, maybe not. But if you are caught, it's going to be expensive. So.
Okay, well, I think that about wraps it up for us today. We've got a minute to go, so I'm going to turn it back over to you, Amber, then, to close this out. Thank you again, everybody, for joining us.
All right. Well, thank you, Carol. Thank you, Roger and Carol, for sharing your valuable time and expertise with us today. To reiterate, today's presentation was recorded, and we will be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed by Monday, you'll receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At the end of this call, a survey will populate in a new window. Please take a brief moment to complete the survey, as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you, everyone, for joining us, and have a great day.